Hi, it's Marc Ventura here. Today I just wanted to run over a video in relation to buying property in a self-managed super fund. And over the last couple of years, buying property in self-managed super has been absolutely all the rage. It's been massive. Lots and lots of people are getting in on the act and loving, I guess the control that they can get out of buying property in super, but probably more so the feeling that they feel like, you know, property is generally increasing a lot more steadily, and they feel like they're getting, I guess, you know, better results than whether that money is potentially invested in, you know, shares and managed funds, where they feel like, you know, it's quite volatile and they really can't see, I guess, the increase in value over time. So today I wanted to touch on, I guess, you know, when you're setting a self-managed super fund up, what's the structure involved, and how does it all work at the end of the day? So this video is going to be, you know, an example only. It's going to be quite generic. It's not personal advice in any way, but it's really just more about just giving you an idea of, you know, what's the structure, or how does it look, what's all involved, and how do we go about buying property in super. So I'm going to flip over to the board and start giving you some examples. So I've got some boxes here, and I'm just going to put some information around those. So when we're buying a property within self-managed super fund or within self-managed super, the first thing we need to do is set up a self-managed super fund. So that's the first thing that we need to set up, and we need to naturally essentially roll the assets or the money that's in the existing superannuation, roll that money into the self-managed super fund. Now, when you're buying property, you can do that a number of ways. If you've got enough cash in the super fund, then you can use the cash to buy the property. Or if you're wanting to obtain finance, you can do that as well. And generally what we need to do is there's a couple of other things that are very important to understand. Now, the first is having what they call a bare trust. Now, the property must sit inside the bare trust. It needs to be separate to the actual self-managed super fund assets. Particularly this is important to understand when there's lending or there's a loan involved. And the reason why particularly it's important when there's a loan involved, because there's something that we need to understand called limited recourse borrowing arrangement, or it's commonly referred to as an LRBA. And what that means is an LRBA, or limited recourse borrowing arrangement, what that means is that in the event of, say, defaulting on a loan, the bank can only touch the assets within this bare trust. They can only touch this property. They actually cannot touch the assets that are still sitting inside the super fund, whether that may be cash or shares and things like that. So the property must sit within this sort of bare trust arrangement. It's there to protect, I guess, the beneficiaries of that super fund. So this is just a short video today, just to give you an overview of essentially, you know, how to structure or how the property ownership is structured within a self-managed super fund. Cheers.